Okay, let's dive in. We're tackling a topic today that really sits at the heart of trading the financial markets, specifically Forex. Forget the charts and indicators for just a moment. Today's deep dive is powered by a collection of sources our listeners shared, and they all point to something, well, fundamentally human.
That's right. For many people, the journey into trading, it starts with technical analysis, right? Maybe some fundamentals.
Yeah, the usual stuff.
We pore over price charts, learn patterns, try to predict where things are going. And look, those skills are essential, but these materials argue pretty compellingly, I think, that they are nowhere near the full story.
Exactly. Our mission with this deep dive, then, is to pull back the curtain on those crucial, often underestimated psychological factors that, according to these sources, are the real difference makers. The surprising emphasis here is firmly on your state of mind, your discipline, your mindset, maybe not just your skill with a trading platform.
Let's unpack this a bit. The sources start by painting a picture that's probably incredibly familiar, maybe even frustratingly so, if you spent any time trading.
Oh, yeah.
You spot an opportunity, you place your order, and almost immediately the market goes against you. Boom, your stop loss is hit, you take a loss.
Ugh, the instant regret, that feeling.
Right. But the story often gets, well, worse. After stopping you out, the market then turns around, finally moves in the direction you originally anticipated.
Of course it does.
But it stalls out just shy of your profit target. You watch it maybe for hours before finally giving up and, manually closing the trade, perhaps for a tiny fraction of the profit you aim for, just to salvage something.
It feels like the market is just personally waiting for you to get in or out sometimes.
The sources explicitly call this scenario out. They say this exact pattern, getting stopped out, watching the market turn, then manually exiting for small or no gains, is a well-trodden path.
Leads nowhere good, I'm guessing.
Leads directly to accounts being wiped out, whether it's a demo account or, real capital.
And the core realization that hits many traders, often after they've lost significant capital, is that the psychology they initially dismissed as, worthless, fluffy stuff, is actually everything.
What's really striking is how the material positions emotional control. It's not just a factor, it's presented as the defining line, the key differentiator between a professional trader and a beginner.
So it's not that pros don't feel it.
No, they aren't immune to the market's moves, but they handle them differently because of their internal discipline, their setup.
Because, and these sources are pretty blunt about this, the Forex market isn't a place where everyone wins. It's just not built that way.
Not at all. For you to make money, someone else has to lose it. Money just transfers from one pocket to another.
A zero-sum game.
Exactly. A zero-sum game that really lays bare our emotional vulnerabilities.
Okay.
And those vulnerabilities, they manifest as key obstacles. The sources categorize these challenges into 3 main areas that block the path to consistent success.
Okay, so if psychology is the differentiator, what are the main ways our own minds trip us up, according to this material? What's the first big one they highlight?
The first is that potent combination of greed, pride, and overconfidence. The sheer speed of potential gains in Forex is a massive lure. People see the possibility of making fast, easy money.
Right. The dream.
But what they often ignore, or maybe choose to ignore, is that the speed of loss can be just as, if not more, rapid.
The hope of getting rich quick overshadows the risk of getting poor quicker. That's a good way to put it.
Precisely. People without deep financial literacy, maybe chasing that dream, can lose their entire trading capital in days, sometimes even hours.
Wow.
And this hope, this desire, it fuels excessive pride and overconfidence. You put on what the sources call optimism glasses.
Optimism glasses. I like that.
Yeah. When a trade goes your way, maybe just by luck, you feel like a genius.
Been there.
And that feeling that sets you up for disaster on the next trade.
Okay, so how do these sources suggest we build defenses against that? Against that, intoxicating mix of greed, pride, and overconfidence? Seems tough.
It is tough, but they argue it's all about establishing a rigorous structure before you ever place a trade, a structure that emotion can't easily dismantle.
Right. Logic over impulse.
Exactly. First, they emphasize you must define your trading system. Really define it. This means testing strategies thoroughly, ideally on a demo account first, until you have a clear, tested approach you trust.
Makes sense. So you know why you're trading.
Yes. Then determine your leverage based on your account balance. Leverage, remember, it's using borrowed capital to increase your trading size.
It magnifies everything.
Right, magnifies both potential profits and losses. The sources are clear. Less leverage generally means less risk, which is crucial for managing that emotional pressure.
Okay, what else?
You absolutely must define your risk management. The material is really strict here. Risk should not exceed 5% of your trading balance per single trade.
5% max. Got it.
That's your primary shield against blowing up your account because of a few bad trades, maybe driven by that overconfidence we talked about. And before entering, calculate your profit goals. How much money do you actually aim to make? Convert that to pips, the price movement. This is your concrete target.
And stick to it.
That's the critical rule here. Never deviate from your goal. Any deviation, they warn, it comes from emotion. Usually greed pushing you for more, or sometimes fear making you take less too early.
That takes discipline.
Huge discipline. And after a successful trade, the sources recommend something that feels counterintuitive for the impatient trader.
Which is?
Rest for 1-2 days.
Really? Just stop.
Yep. This isn't laziness. They say it's essential to regain composure, to look at the charts again with a clear, objective mind, free from the high of winning.
Okay, reset. That makes sense.
And if a trade hits its profit target and the price keeps moving favorably.
Oh, the temptation.
Massive temptation. But they say never re-enter. That second impulse, that's pure greed talking. You met your goal. Stick to the plan.
Hard rule.
Very. They also advise taking partial profits from a positive trade. This secures some gain before, something unfavorable happens. The sources wryly note that luck runs out.
Lock some in. Smart.
And of course, this is fundamental. Use stop loss and profit limits on every single trade. These are your predefined exit points.
They're safety net.
Exactly. Protecting you from sudden, adverse price jumps, preventing those emotional decisions in the heat of the moment.
Okay.
Then there's a powerful warning. Never enter a trade mid-move. You don't, as the source puts it, ride a moving train.
Chasing the market.
Yeah, jumping into a fast-moving market is incredibly risky. You're likely to lose capital and quickly become emotional as the volatility whipsaws against you. Bad entry point.
Got it. Any other rules for this first hurdle?
Finally, avoid overtrading. This is a classic sign of chasing the market, often driven by greed or maybe just the need for excitement, for action. The sources suggest a maximum of maybe 4 trades per day to keep execution disciplined.
Wow, that's a really comprehensive set of rules just to combat that first emotional hurdle. Greed, pride, overconfidence.
It really is. It shows how intertwined structure and psychology have to be. You need the rules to manage the feelings.
Absolutely. It's like building a framework that forces logic when your emotions are just screaming at you. Okay, so that's the trap of wanting too much too fast. What's the second major obstacle they identify?
It's kind of the opposite extreme. Fear of loss and hesitation. This often creeps in after maybe an initial period of success.
Right, you get a few wins.
Exactly. Maybe demo trading went really well, or you had a few winning live trades, which then leads to some carelessness, maybe breaking your rule.
And then losses start happening.
Right, resulting in losses, a shrinking balance, and the inevitable onset of doubt, that little voice.
The moment you start asking yourself, is this really for me? Or maybe I'm just not cut out for this. Yeah, I know that voice.
Precisely. And according to the sources, this is the point where most beginners just give up. They quit.
And they blame everything else?
They look for external reasons, the broker, their trading system, their teachers, the amount of their deposit, anything but the real issue.
But the sources are unwavering on this point, aren't they?
Completely. They state very clearly, you are solely responsible for your losses. Period.
Ouch. But necessary, Pratna.
Necessary for growth, yeah. They argue that overcoming this fear requires that same emotional control we talked about and, crucially, solid capital management, both of which stem from emotional stability.
So stability leads to control and better management.
Exactly. Those are the tools that eliminate the crippling psychological component of fear and help instill discipline.
So when fear and hesitation start to dominate, what practical steps do the sources recommend? How do you fight back?
Okay, so if you experience multiple consecutive losing trades without a clear reason, meaning you followed your strategy, it seemed sound, but the outcome was negative.
Market just didn't cooperate.
Right. They advise working on a demo account for 2-3 days. This isn't punishment. It's about reviewing your strategy objectively, away from real money pressure to regain confidence in your approach. Recalibrate.
Take the pressure off. Okay.
And above all, never panic. If you find yourself constantly trading from a place of fear, they suggest stopping trading temporarily. Just step away until your mind is clear.
Take a break.
Absolutely. Now, here's a tough one. If you genuinely believe based on your analysis, that a trade will eventually become profitable.